For more on today's action, I want to bring in Brian Belski, BMO Capital Markets Chief Investment Strategist. And Brian, not just today's market move, but really what we've seen over the last couple of weeks. So we're seeing this big decline today, but before that, markets were actually seem to be able to brush off some of the negative sentiment that we have been getting in the markets. What's your read on what we're seeing today and what we've seen over the last couple of days?
Well, thanks for having us, and it's a great question. And also, too, thanks for not just focusing on today. I mean, a lot of my calls and conversations today are really quizzing me whether or not this selling may go away. I just think that it's way too soon to be jumping on that bandwagon. But I really think the thing that's gone on the most over the last couple of weeks, Seana, is clearly, I believe, this transition into quote unquote more normalized ways of looking at the market. What do I mean by that? We as investors or strategists or portfolio managers or economists, we're used to looking at things like valuation and earnings and economic data. We're starting to look at those things again versus trying to talk about remdesivir or hydroxychloroquine or all these weird words that we've never said before or actually never knew before all this happened. And what happens in our world is, as analysts, we want to learn as much as possible about what's going on right now. I saw this in 2008, 2009 during the crisis. I saw this back in 2000, 2001 during the tech wreck, and then post 9/11. We want to immerse ourselves in whatever's happening right then and there. And I think we kind of took our eye off the ball. And because of that, we actually became very emotional and was really driven, by fear and rhetoric. And I think some of these projections with respect to Q1 and Q2, albeit probably very accurate in terms of how negative they are, but I think a little bit too bombastic on the negative side when we making claims of 10 times worse than the last crisis or worse than the Great Recession. Because here's why, Seana, nobody knows. So as we transition back into looking at stocks and fundamentals and now transition the fear factor away from the virus and now into how many people are going to be going to a bar, how many people are going to be going to a restaurant, how many people are going to be on an airplane, we can measure that and we can invest around that. And I think that's a major thing that people need to understand.
Hey, Brian, you mentioned the fact that we're getting back to that more normalized way to look at the markets. And I want to zero in on one of those examples that you said, and that's earnings, because during this earnings season, we're still not getting guidance from a lot of these companies. And I've asked a couple of our guests over the past couple of days just how they're parsing through the earnings reports that we're getting, how they're reading it as a forward-looking indicator, just because a lot of the information that we're getting from these companies is backward-looking at this point. How are you deciphering that? How are you reading the earnings this time around?
Well, that's why we've looked at more trailing earnings, quite frankly, Seana, and I think you can't really make an assessment until the second half of this year. That's why on March 23rd, we came out on a note and said we're suspending our year-end target on a calendar basis and moving it to a rolling 12-month, because as an investor, you look out 12 months. You don't look at, where are my stocks going to be on December 31st? It doesn't really work that way, okay? And so I think we can't really, as an investor base, let alone companies, get a good feel for what the earnings actually are until they happen. Forecasting tools are very difficult right now. Remember, too, that the first 2 months of the quarter, January was a great month, and the first half of February, great. And so it's really the last 6 weeks of the quarter. So now think about that as we kind of come out of this. Now the first 6 weeks of the new quarter are going to be terrible. And then the next 6 weeks, I think we're going to see that less negative second derivative change. So it's a tale of two quarters, but it really helps define what's going to happen the second half of the year, where we're not really seeing real math, quote unquote, in 2020. The real math and the real investing and the real earnings and the real valuation, Seana, quite frankly, happens in 2021 and 2022. So I think that's really what people need to start looking at. So therefore, less about May 1st, selling may go away, but more about what the trajectory and the trend is. And we still think, given the fact that the United States is the best companies in the world, are the best positioned to kind of get through this, because they have before and they will again.
Right. I know we can't say sell and may go away right now because it's only May 1st and still a lot can happen up until we could potentially say sell and may and go away. But I just want to ask you about those types of old saying, those old mantras in an environment like that, like right now. Is that just completely out the window?
I sure hope it is. But I think, what happens is, and I think why so many people struggle, quite frankly, is we as analysts and strategists look to the past for a roadmap. And I've used it. A lot of people have used the word unprecedented. What we saw in March was unprecedented. 22-day cyclical bear market. I mean, come on. I've never seen it. Nobody's ever seen it. And so I think what's setting up for, given the fact that we've had this unprecedented response from monetary policy, you know, in every recovery in the world, it doesn't matter what's going on, whether or not it's your life or the stock market, we move from despair to hope, and we're slowly moving more into hope. Now, remember too, anytime you invest, Seana, you're taking risk, right? You're taking risk by walking outside of your apartment, walking on the street. We have to start to embrace that a little bit more, and that's how we're going to get back to normal. Now, selling may go away, or you know, typically and historically, stocks do worse between May and August. Everybody knows that. So now we need to start. Now we need to really start digging into what we don't know, and what we don't know is exactly what earnings are going to be first and second quarters. But we need to embrace the strength and wherewithal of the U.S. companies and especially the U.S. consumer.
Yeah, it certainly does make a lot of sense when you put it that way. Brian, I want to bring up a recent note that you just put out this morning because it caught our attention. Now, you mentioned the outperformance in consumer staple stocks since the start of coronavirus, and that's something that we've been covering pretty extensively here on Yahoo Finance. But as the S&P recovered, it's interesting because this sector has been a notable laggard over the last couple of days, last couple of weeks. Do you think this sector, the consumer staples sector, is too crowded of a trade at this point?
We think it's very crowded. And to be clear, you know, the problem with looking at, let's say, ETFs, Seana, is that great stocks and stocks that we own in portfolios that we run, real live money for private clients in the US and Canada, we own stocks like Costco and Walmart, which are technically consumer staples names. Now, I believe Costco is top 25 company in the world, period. But it's skewing what's happening in the ETF. So what do I mean by that? In the ETFs, you're going to have the names that we're actually really worried about, which happen to be those traditional food product names or household product names that have been a part of the hoarding technique, like whatever or not it's tissue paper or Lysol or paper towels. We bought too much of them. So now what are we going to do with them after this? I mean, look, we have to come back to reality and common sense that now we have too many of those things. So think about this as a lesson in terms of investing, scarcity versus capacity. And so now we've taken on too much capacity in many of these products. And for the record, we were bearish these stocks before all of this happened because of the new way of buying things, quite frankly, Sean. I mean, we are going to be buying toothpaste, soup, and toilet paper from Amazon going forward. We are. And so what is the trend in Amazon, quite frankly, is more and more private label. And I think that actually puts more and more risk on these household product companies and food product companies going forward.
Hey, Brian, I want to ask a little bit of a broader market question here. And it's interesting, some of the headlines that we got out today about President Trump blaming China for the outbreak. He's been doing that now for quite some time. But we had White House economic advisor Larry Kudlow making some comments, and he was saying that China will be held accountable for the virus. From an investor perspective, I guess those types of comments, how much is that, do you think, weighing on investor sentiment at this point?
I think it is today, quite frankly, Shauna, because the saber rattling really was what held stocks down in 2019 and 2018 in terms of all the tariffs. And it wasn't until we kind of moved past that to when we really started to get going again. Clearly, the Fed cutting interest rates 3 times helped out a lot as well. But towards the end of 2018, you have to go back and think about what happened in December 2018 when the tariff talk was at its highest and the Fed still was cutting rates despite what was happening in tariffs. Think about what that did. Now, from a fundamental perspective, let's also think about the impact of what happened in China. We've already, coming into this year, based on what was happening in tariffs, started talking about how are supply chains going to change going forward. Now we have a human element to this with respect to the potential involvement in China and all of this. But also, this was already beginning to develop prior to coming into this with respect to supply chain. So we're thankful that we have the new USMCA signed within North America. There's several opportunities to bring supply chains back to the United States and to Canada and to Mexico. I think a major theme that you're going to hear about going forward is this whole notion of onshoring or repatriation. A lot of people forget post 9/11, we had a repatriation of money, came back to America for a while. President Bush came out and gave companies cuts for bringing their cash back to the United States. Now, I don't hear anybody talking about that. I think we're going to start hearing more about that, Shauna, quite frankly. But I think a major theme heading into the next several years is going to be this onshoring and repatriation of companies out of China back into North America, Canada, United States, and Mexico.
All right, Brian Belski, Chief Investment Strategist at BMO Capital Markets. Thanks so much for taking the time. We love having you on.
Thanks for having us.